What if I told you that retirement isn't an age, it's a number? And for many Australians, that number is far more achievable than they think. You don't need to win the lottery, inherit a fortune, or build $1 million business. You simply need enough investments generating income to cover your living expenses. In this video, I'll show you exactly how Australians are using dividend investing to retire years, and sometimes decades earlier than expected. The traditional retirement model is changing. For decades, Australians were told to work until their mid to late 60s, build up their superannuation, and then retire. But rising living costs, increasing housing expenses, and economic uncertainty have led many people to ask a different question. Can I retire earlier? The answer is yes, but only if you understand how to replace your employment income with investment income. By the end of this video, you'll know how much money the average Australian actually needs each year, how much you'll need invested to generate that income through dividends, the dividend investing strategy many Australians use to build passive income, and practical steps you can start taking today to move closer to financial independence. Let's get into the numbers. Before you can retire early, you need a target. Many people make the mistake of choosing a random number, like $1 million. But retirement isn't about how much money you have. It's about how much income your investments produce. According to various retirement estimates, a comfortable retirement for a single Australian often requires around $50,000 to $60,000 per year. For a couple, that figure is typically around $70,000 to $80,000 per year. For simplicity, let's use a target of $60,000 annually. That means your investments need to generate approximately $60,000 every year without you working. Now let's see what that requires. When you own shares, some companies pay a portion of their profits back to shareholders. These payments are called dividends. For example, if you own shares in major Australian companies, such as banks, mining companies, or diversified ETFs, you may receive regular dividend payments throughout the year. Many Australian dividend-focused portfolios generate yields between 4% and 6%. Let's use a conservative dividend yield of 4%. If you want $60,000 per year from dividends, $60,000 divided by 4% equals $1.5 million invested. That means a portfolio worth approximately $1.5 million invested could potentially generate around $60,000 annually before tax. If your portfolio generated a 5% yield, you would need approximately $1.2 million invested. At 6%, you would need approximately $1 million invested. This is why understanding dividend yield is so important. Small differences in yield can dramatically change your retirement target. Australia is one of the best countries in the world for dividend investors. Many large Australian companies have a long history of paying dividends. Examples include the major banks, large mining companies, infrastructure businesses, dividend-focused ETFs. One advantage Australians have is franking credits. Franking credits can reduce the tax paid on dividend income and improve overall investment returns. This makes dividend investing particularly attractive for Australian investors compared to many other countries. However, there's an important warning. Never invest in a company solely because it has a high dividend yield. Sometimes extremely high yields are a sign of financial trouble. Always focus on quality businesses with sustainable earnings and a history of reliable dividend payments. Now comes the question everyone asks. How do you actually build a portfolio worth $1 million or more? The answer is surprisingly simple. Invest consistently. Let's look at an example. Imagine you invest $1,000 every month into a diversified share portfolio. Assuming an average annual return of 8%, including dividends and growth, after 10 years, you could have approximately $180,000. After 20 years, around $590,000. After 30 years, over $1.4 million. That's the power of compounding. Your money begins earning returns. Then those returns start owning returns. And over time, the growth accelerates dramatically. This is why starting early matters so much. The investor who starts today often needs far less money than the investor who waits another decade. If your goal is early retirement, your savings rate matters more than almost anything else. Most Australians focus on earning more, but the real secret is creating a larger gap between what you earn and what you spend. If you save 10% of your income, retirement may take decades. 20% accelerates the process. 30% or more can dramatically shorten the timeline. Many people pursuing financial independence aim to invest every pay cycle before spending what's left. This approach ensures investing becomes automatic rather than optional. The more you invest today, the faster your future dividend income grows. One of the biggest mistakes investors make is spending dividends too early. When you're building wealth, dividends should be reinvested. Every dividend buys more shares. Those additional shares generate even more dividends, which buy even more shares. This creates a snowball effect. Eventually, the snowball becomes large enough that the dividend income alone can cover your living expenses. At that point, work becomes optional. And that's the real goal: financial freedom. The term retire early can be misleading. Many people who achieve financial independence don't stop working completely. Instead, they gain choices. They can work part-time, travel more, spend time with family, start a business, or simply work because they enjoy it. Dividend investing isn't just about quitting your job. It's about creating enough income that you control how you spend your time. And ultimately, time is the most valuable asset any of us have. Retiring early in Australia isn't about getting lucky. It's about building a portfolio that generates enough income to support your lifestyle. Know your annual spending, calculate your income target, invest consistently, reinvest your dividends, and give compounding time to work. If you found this video helpful, subscribe for more Australian investing, dividend, and financial independence content.